Hey everybody, it's Rob Keynes of goldsilverpros.com. It is Friday, August 27th, 2021, and I'm doing a video today because we wanted to talk about Jackson Hole and Fed Powell's comments on the economy. I think this is really important. Jackson Hole is sort of their annual get-together for the Fed, typically in person, although this year, for the second straight year, it's been virtual due to concerns over the virus spreading. But it's where they give guidance on what they may do the rest of the year. And why this is important, why I'm doing a video just on this, is because in July, Powell made some vague statements about what would need to happen in the economy before the Fed changes position. And he made vague statements on purpose. We know that the Fed looks at lots of data points and looks at a lot of things when they make their decisions, but he's not giving away the secret sauce. He's not giving away the secret formula, the Coca-Cola, so to speak. But he did provide some very interesting statements here. And it's a lot of trying to not panic the market and not try to give too much information, but provide some guidance. And I also think that Powell's basically full of shit here. And that's what I want to talk about. Some of his statements are absolutely asinine when you look at the actual data. And you guys know me, former auditor, I'm going to look at the data. I'm a data geek, right? So I look at the data, I look at what he says, and I think he's not living in reality. I think he actually knows reality, but I think in his mind, he can't talk about reality because it would absolutely panic the markets. And you don't want to panic the markets. You want to crash the stock market. So we are going to separate his comments from reality. We're going to show you reality. And I'm going to talk about why central bankers never really tell you the truth and how Powell, unfortunately, has become one of those, and how basically he's full of crap. But if you read between the lines, I think we can see what he's going to do. Now, he didn't give specific guidance on when they're going to do things specifically. He just talked about what they could do this year. So we'll talk to you about that and we'll get into it. I'm going to look at Bloomberg and CNBC stories and kind of walk you through them. And then I'm going to take you through a series of data. This video will probably be around anyway from 25 to 35 minutes. All right, here we go. We're going to start here at Bloomberg. And this is interesting. This came out not too long ago, a couple hours ago, my time. Powell says taper could start in 2021 with no rush on rate hike. So two things we're talking about here. The biggest policy tools that the Fed has. They have others. The two of the biggest are, one, buying debt, directly monetizing debt, our central bank monetizing it from our treasury, and two, raising or lowering interest rates. They're saying nothing on the latter. They're not going to do anything with interest rates this year. That's what they're saying. But they could start the taper first. So they're going to address all their bond buying. Now they have a 120 billion a month bond buying program. They say tapering, they're going to pull it back. What happens when you taper that debt purchase? It means somebody else has to buy that debt, which means you run the risk of the Treasury not being able to issue the debt that it wants to. Could affect the interest rates in the Treasury market, the liquidity of the Treasury market. It could have a big effect. But the bigger thing that would have an effect on the stock market is interest rates, and that's why they're not doing it yet. So they're going to tackle bonds first. I think, I'm interpreting, see how that goes, and then talk about interest rates next year. Let's get into what he said here. The first paragraph basically gives you the sum of the story. Federal Reserve Chair Jerome Powell said the central bank could begin reducing its monthly bond purchases this year, although it won't be in a hurry to begin raising interest rates thereafter. So in other words, at some point in this year, lowering their 120 billion bond buying program, not stopping it necessarily, but lowering it. They could stop it, but it says here tapering, which means slowing it down. Maybe they drop $1 billion, maybe they drop 50 billion. I mean, who knows? And that they're not going to do interest rates this year, most likely, or at least they're not in a rush to do it. They're not going to raise interest rates, obvious reasons for that. But it doesn't say exactly when he's going to begin the tapering program. Okay, so not a whole lot of clarity, but if you take July and you take now Jackson Hole in August, the Fed is going to cut its bond buying program. It's going to do it. It's set that expectation 2 straight months in the market. If it doesn't do it, the market's going to react. How much they do it is what they're probably trying to figure out. And I think they're trying to condition the markets to see how they will react before they actually decide how much and when. And we're going to see here in a moment how the markets are reacting very oddly to this news, almost the opposite of what would happen. But we live in a Alice in Wonderland world in which the economy does not react the way it should when you talk about the central bank anymore. It says here, the economy has now met the test of substantial further progress. That was Powell's quote from July that was very vague and nobody knows what it meant, and he's still not telling us now, toward the Fed's inflation objective that Powell and his colleagues said would be a precondition for tapering the bond buying. While the labor market has also made clear progress, the Fed chief said Friday in a prepared text of the Kansas City Fed's annual Jackson Hole Symposium. So I'm going to dispute those statements here in a moment with real data, but let's get further into the article in the comments first, and then let me rip all this apart for you guys. At the Fed's most recent policy meeting in July, Powell says, I was of the view, as were most participants, that the economy evolved broadly as anticipated. It could be appropriate to start reducing the pace of asset purchases. The intervening month, that means between July and now, in August, has brought more progress in the form of a strong employment report for July. No, I'm sorry, it hasn't. But also the further spread of the Delta variant, he said, will be carefully assessing. Investors took the news in stride. The markets went up. I'll show you the markets here in a moment. They're up. It's ridiculous that they're up. That the Fed is now going to stop supporting the debt market, and now the companies that are reliant on debt market rates are now going to trade up on the stock market. Explain that one to me. Chair Powell stuck to the script in his Jackson Hole speech. Anyone hoping for a steer on the timing of the taper will be disappointed, because he didn't say when they're going to do it, but it was never likely, said Ian Shepherdson, chief economist at Pantheon Macroeconomics. At the July Federal Open Market Committee, FOMC, meeting, most Fed officials agreed it would probably be appropriate to begin tapering the bank's $120 billion a month bond buying program. Maybe as soon as this month, because that was last month in July, but I don't think it's going to happen here. I think it's going to happen sometime in the last 4 months of the year. Monetary policymakers would like to conclude the purchases before they begin raising interest rates, and several in June saw a possible need for rate increases early as 2022. So that's your signaling that they think they may raise rate in 2022. Whether they actually do, they're going to see what tapering does first before they touch interest rates. Now, I will remind you, the last time the central bank raised interest rates, we had a 20% stock market correction in late 2018. So we'll see if they can actually do it now. The Fed cut its benchmark rate to nearly zero, relaunched a crisis era repurchase program last year at the onset of the quote unquote pandemic. Every time I say pandemic, it's going to be quote unquote, because when you look at the definition of pandemic, it's up to us to decide whether we agree with that. So I'm going to use it in quotes. I'm not supporting whether it's a pandemic or not. I'm being Switzerland, but it deserves quotes. All right. And that's my last comment on that. Powell cautioned that a move to begin winding down the bond buying program should not be interpreted as a sign that rate hikes would soon follow. Timing and pace of the coming reduction asset purchase will not be intended to carry direct signal regarding time interest rate liftoff. So we don't know about interest rate liftoff. Now here's where it gets really asinine and stupid. Listen to what he says here in this highlighted paragraph. We have said that we will continue to hold the target rate for the federal funds rate at its current level until the economy reaches conditions, listen, consistent with maximum employment. I'm going to show you that in a moment. And inflation has reached 2%, is on track to moderately exceed 2% for some time. Hasn't it been over 4 and over 5% the last 4 months of the year? Is he saying that it's still below 2 and hasn't stayed above 2? What in the fuck are you talking about, Powell? That makes no sense. Let me show you the data on the CPI in a moment. He says we have much ground to cover to reach maximum employment. Yeah, I'm going to show you how much ground, and you're not going to get there because Fed policies have caused a plummeting rate of full employment. And time will tell whether we have reached 2% inflation on a sustainable basis. What, the last 4 months hasn't told you that, Powell? Or 5 months? Because I think 5 months ago, wasn't it 2.6? That's almost half a year. How long do you need? What do you consider, you know? Okay, anyway. More stuff here. Quarterly projections in June showed 7 of 18 FOMC participants thought it'd be appropriate to begin raising interest rates next year. So not a consensus, not even a plurality. Most of them don't, but some saying maybe 2023. So that's your timeline. A little bit less than half think 2022, maybe more by 2023. So somewhere in the middle between 2022 and the start of 2023, maybe when they begin doing it, unless something happens in the economy before then, something big. It says on net tapering remains on track. And the next question will be appropriate to hike, blah, blah, blah. Total, oh, here's another one on employment. Total US employment, this is by Bloomberg. It's still about 6 million jobs below pre-pandemic levels. June and July were strong months for hiring as restrictions on service industry were lifted, but the recent spread of the Delta variant is raising uncertainty about prospects for the months ahead. So in other words, we haven't really gotten to full employment anywhere near. And listen to his comments on wage price spiral. That's when wages keep going up because there's pressure on finding talent, and also price increases cause wages to have to go up to keep up with it as employees demand higher wages. So Powell noted that there's little evidence of a wage price spiral while pay increases might threaten excessive inflation. Yeah, because there's not full employment. I'll get to that in a minute. He pointed to inflation expectations measures as a sign that consumers, businesses, investors also share that assessment. So on and so forth. So they go on to talk about some global factors, blah, blah, blah. Let's get into the CNBC article. I just want to read the bullet points for you here to start off with. Powell indicated Friday the central bank is likely to begin tapering. He said rate hikes and interest rates are not imminent. There's still much ground to cover. What does that mean? Much ground to cover. And it was part of Jackson Hole Summit. Let's go down here and read something that's, here we go. The timing and pace of the coming reduction in asset purchases will not be intended to carry direct signal regarding the timing interest rate liftoff. We read that in the Bloomberg article. Markets reacted positively to Powell's comments, sending major stock indexes to record highs while government bond yields move lower. Again, why would the stock market indexes go to record highs? This makes no sense to me. If the central bank is going to stop supporting the debt markets and potentially raise interest rates, why are the stock markets going up? Again, the way the algorithms are trading this market as any news is good news. It's not the traders, it's the algorithms. I think that's what happened. So in other words, anytime the Fed says something that could be contrary to what the economy should, or says something that could affect the overall economy, the stock market acts contrary to that by ramping it up as a signal to investors to keep pouring money in the stock market. In other words, they don't want people to come out of the stock market. They need the money in the stock market for reasons I'll cover in another video at a later time. They need that money. So the algorithms will trade up the stock market even when news comes out that should negatively affect the economy in the long run. Okay, so don't look to the stock market as your key signal, look to the underlying data. The Fed has used the term substantial further progress as a benchmark for when it'll start tightening policy. Powell said the test has been met, for inflation where there's been clear progress towards maximum employment. No, there hasn't. At last year's Jackson Hole Summit, this is a year ago, Powell outlined a bold new policy initiative in which the Fed committed to full inclusive employment, even if it meant allowing inflation to run hot for a while. So here's the thing. The Fed thought that if they kept their policies in place and bought more debt and kept interest rates low and it got full employment, they were okay with inflation running hot. Now we have inflation running hot, but we don't have full employment. And so the Fed has failed, and I'll show you that. So let's just get into the data. First of all, the Dow jumps 250 points, S&P 500 makes no sense. I've talked about that. That's absolutely silly. Let's look at the consumer price index. This is the BLS report for July. This is the latest data that we have month over month. Over the last 12 months, month over month, the July CPI was 5.4%. That's much higher than 2. Okay, and if you look at the trend, here's the month over month, but if you look at the overall trend, it's much higher for several months. It's been over 2 for a long time. It's been over 2 since April. Okay, so what's Powell saying? That it hasn't been comfortably above their target of 2% before they would see substantial progress and begin the tapering. How long did he need that to happen? It makes no sense what he's saying. I don't think he's actually looking at the CPI data. I think he has an alternative plan for doing what he's doing, and he's lying to the market about the CPI. It's been high enough that you could have talked about tapering at this point. Here's the overall from BLS.gov breakdown on CPI. The latest, energy is up over 25%. Of course, we all use energy to heat our homes, to power our vehicles, all that kind of stuff. Even if you use an iPhone, you're using energy, and those prices are substantially higher than the 5.4% for July. Food, this one's actually higher. We'll get into that in a moment with shadow stats, all items less food and energy. So energy is driving it according to CPI, but you look at real inflation, it's higher. So if you look at inflation measures, today using 1980 government numbers, in other words, compare apples to apples. So if we want to compare the way we measured inflation 1980 to now, so that we can compare periods, you see that the CPI has spiked to about, I want to say over 13, almost 14%. So in 1980, if we'd been reporting the consumer price index or the inflation, it would have been 14%. Okay, now they're reporting it much lower, because about 5.4%. Because what they've done is they've made hedonic adjustments, geometric weighting, all those things, and they're suppressing the price of like food and all these other items, using those things to mask it. But if you just straight look at price with no adjustments, then you're sitting at about 13 to 14%. I think this is a true inflation number. So again, makes Powell look like an idiot when you look at true price inflation. Just what is the measure of the prices, now from prior periods in real terms without making all these goofy adjustments to try to lower that. So what's happened to unemployment? So the U6, the unemployment rate has gone down. It's gone down since the beginning of the year from about 6.3% down to the 5.4. So if you're only looking at the U6 rate, yeah, it looks like unemployment's come down. We're not at max employment, obviously, still got 5.4%, but I could see where Powell would say, okay, yeah, we've had improvement on unemployment, since the beginning of the year. And if we go back to 2020, and we can see the mass unemployment we had after the quote unquote pandemic got to almost 15%, it has come down, which is good. It means some people are hiring, people are back in the service industry, those industry most affected, airline service, so on and so forth, have had a nice recovery. But is that the end of the story on unemployment? No, it's labor force participation rate. So I want to make a distinction between unemployment and labor force participation rate. For those of you that haven't been watching my program, and I haven't covered this in a wee bit, in a couple of months, I'm going to go over it again. The labor force participation rate is the net, how many eligible employees do you have in a society, period, net, how many are actually working. So the unemployment rate, the U6, what it does is after you've been what I call a disaffected employee and you haven't had a job for a year, it just drops you. So there's structural, what I call structural unemployment, are those people have been unemployed for over a year and fall off the U6 number. That's structural unemployment. That the structure of society, the monetary system, the economic facts of society are that a certain amount of people after a year can't find jobs, but that still affects the overall quality of living in America, our overall GDP production, ability to collect taxes, ability to grow, how much we're going to spend on social programs, all that stuff. So it matters. So to me, the labor force participation rate always matters more than the U6, because when this gets lower, it means more money spent on government programs, less economic growth, more crime. I've showed you that in a previous video the Nixon video, when I mapped since 1971 to now how drug use and crime has absolutely exploded. So that's what this matters. When you have less people employed, you've got all those things that matter, and that's not captured in the U6 rate. So even though this rate's going down, that's good. That's measuring only a subset of the basically less than 1 year unemployed. It doesn't measure what I call the structural unemployment. So the second point I want to make is look at what the Fed has done with monetary policy and how it has not helped this number, but hurt it. So when you look at like 1965, when you have a low about 58.6%, actually 1955, when it was down here, 57, some it looks, 58.1, to its peak in about 1999, right before the tech crash. This is the tech crash here. We had peak employment about 67.3. That's about a little over 2 out of every 3 eligible people employed. That was our high dating back to the 1950s or 1948, according to this chart right here. Okay, so since 1948, right before the tech crash in 1999, we had more total people employed than ever. Look at what's happened since the last 2 crises and all of the Fed's easing programs and printing money. Look at that. Okay, and then you had the crash down here in labor force participation rate due to the quote unquote pandemic. And then you had all the money printing and it got it up a little bit. This is the difference. So what you're seeing here, this little rise here in the labor force participation rate is reflected in this number, okay? This number from 15 down to 5.4 is this on the total, what I'll call the total employment rate or the labor force participation rate. Notice how that increase never got us back to where we were before the quote unquote pandemic, nor our previous high in 1999. So we're still sitting at a cyclical low, although we had a nice little bump, but a cyclical low, and have not recovered, as the Bloomberg article mentioned, pre-pandemic. So even if we keep recovering to the pandemic level, we're still at a cyclical low compared to where we've been over the long term. Okay, does that make sense? So this U6 does not tell you that. If you go back to say, let's do 01, 2000. So it'll do 6-1. Oh, wait, let's do 2020-01-01. So if you go to, it's not going to let me do it. It's not going to let me go. Let's do max. Okay, if you go back to the 1950s, the U6 was substantially lower. The unemployment was substantially lower. So even on the U6, you see how it's still higher than it was. But what it misses in this number is the disaffected that just fall off. That's what the labor force participation rate gives you. Now, the second point I want to make, does the Fed policy actually work? Because we're talking in the public and the Bloomberg and the CNBC article and the stock market and all these economists, max employment, inflation rate, things like that are, the mandates of the Fed. Has the Fed policy actually supported unemployment rate? No, you can see in the labor force participation rate. Okay, look at what they printed last year. Look at how much they printed to get it from here to the unemployment from here to here. Okay, They printed 40% or almost 50% of all money ever created, M1 money supply, ever created in 1 year, and they only got it up this much. So does central bank policy really affect overall unemployment that much? No. Now, recently unemployed workers, yes. If you print a bunch of money, you can help recently unemployed workers, not the long-term disaffected that are structurally unemployed through the system, because that's a longer-term effect of what the economy has done to the employment prospects of Americans. Okay, and even though you print all this money, you only get this effect. So the point here being, does the Fed policy actually affect employment, and should we even be considering anymore? If you look at the long-term cyclical effect, the monetary supply, the monetary policy by the Fed hasn't helped things overall with overall employment rates, the overall amount of people that want to work, that find work. And certainly last year, where they dumped all that money in it, only had a slight bump and didn't even get us, as the Bloomberg article pointed out, to quote unquote pandemic levels. Okay, even all this spike in M1 didn't do it. So is the tapering going to get us up here? Probably not, because you're reducing the amount of central bank support. If they raise interest rates and it causes companies to pay more for debt and raise their capital expenditure financing costs, is that going to help companies hire more people? Probably not. So do we see that number going up from here if the Fed tapers and in 2022 or 2023 raises interest rates? No, I see this going down. So we're going to have another down cycle if they do as I actually said in labor force participation rate, which will not be reflected overall in this number. This number is not going to tell you the unemployment rate, the U6, but you'll see this quote in the press. This masks the structural unemployment, and it masks the long-term effects of all this money printing has done to the employment rate in society. Okay, I think I hammered that. I really wanted to get back to talking about this to show, to explain to you central bank policy and how it affects our individual economic outcomes, economic outcomes of our overall society, with the same time showing you that whatever Powell is saying here at Jackson Hole, he's full of crap. Okay, all the central bankers are full of crap. Don't believe what they tell you. Look at the data. The data does not lie. Even the manipulated data doesn't lie anymore, because even the manipulations of the hedonic adjustments, geometric weighting, all those other things they've done to the CPI, substituting rent for mortgage costs and all that kind of stuff. Even those manipulations they've done since 1980 can't hide the fact that their monetary policy is an absolute failure when it comes to our economic incomes in terms of employment and runaway inflation. Okay, I just want to make that point. The last thing, there's a really nice article here at Business Insider talking about the labor shortage. So a lot of people talked about labor shortage. Yes, there's a labor shortage in a small portion of the economy. Now, obviously, there's not a labor shortage in terms of total people, but it's a labor shortage, quote unquote, with certain types of positions, and there are things affecting it. And I wanted to talk about that in this article. 3 explanations for the labor shortage, according to Morgan Stanley. Morgan Stanley they say there's a disconnect between open jobs and what workers want. In other words, there are some jobs available, but they're often less than what these workers are qualified for. So this is another measure of unemployment, even though you have a job. So even though we've reduced this unemployment rate, the other measure of it's not just that you have a job, because if you're working at a barista at Starbucks, but you formerly were a programmer or a NASA engineer, even though you're employed, you're making less money, have less lifestyle. That is also a measure of economic outcomes, not reflected in this U6. This U6 will not tell you that. This U6 does not talk about salary share of GDP, which I've shown before, and it doesn't talk about people taking jobs less fit or that doesn't make them happy. So their overall just happiness, i.e. the pursuit of happiness in the Constitution. Morgan Stanley says some temporary forces are holding back, but there's a bigger mismatch. And the big question is migration. How big and permanent is it, and what jobs will result? It's unprecedented scale, mysterious in its origins, the labor shortage. There's never been such a reluctance by the unemployed to go into open roles. Wages are up, although not as much as inflation, I'd like to point out. The number of people quitting jobs is consistently near record highs, and there are more open roles than job seekers. What do these gaps persist with millions of Americans still unemployed? The answer is more complicated. School closures are playing a role, blah, 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 mismatch between the industry hiring and workers seeking jobs. This is the big one. You can get a degree when you have a 50% unemployment rate on the millennials and college degrees, and now soon to be the Gen Zers, from the jobs that they want. That's underemployment. Now they may get a job, or they may elect just to stay out. In either way, that's a measure of unemployment, because if they get a job as a barista or doing something lower paying or in a different field than they want, that is a measure of economic outcome that's not reflected in the raw numbers. People moved during the pandemic, but jobs didn't. Yeah, there was some movement, but a lot of people were moving to places like Texas which had stronger employment rates and more job creation. So this is a pretty good article at Business Insider picking apart the labor force shortage. What it really is in reality is the people, the jobs that are available are not meeting what people are educated for, what people want to be happy. And so we have an underemployment situation. Either they're taking a job that they don't want, or overall, they're not taking a job at all. They're staying out, maybe taking some government assistance, or living with their parents, or moving in with roommates, or whatever the case may be. And I know a lot of personal cases where this is true. So this is Taper Talk. I want to talk about Jackson Hole. I want to talk about Powell. I want to talk about how the central bankers are always full of crap and how to read between the lines, how you guys can look at data to essentially understand what's really going on, and how you can dig a little bit deeper into some of the numbers. And if you just get a raw number like a CPI number or U6 number, it doesn't really tell you what's going on. So I wanted to make sure that you guys understood that. It's vitally important that you guys understand how to read between the lines, not just listen to policymakers and the mainstream media, which won't break this down for you. We'll do it here at this channel. So as we get more reporting on this type of stuff in the economy, we're going to go back to basics and keep reporting on this. And we're going to do more on the gold and silver talk. So more economy talk, more gold and silver. That's what you guys want. And opportunities like this are Jackson Hole for us to educate the market as to what the truth really is, so that you guys really know, so that you can make your plans for the future. If you're one of those that's economically underemployed, or can't find a job and is what I call structurally unemployed, or facing turning down a job that doesn't meet your requirements, you're going to need to make plans, because if the Fed tapers and if they raise interest rates over the next year to year and a half, it ain't going to help you in terms of your economic outcome, in terms of jobs available. And it sure as hell isn't going to help you in terms of inflation. And sure as hell is not going to help you in terms of interest rates when it comes to things like student loans, mortgages, and stuff like that. So these things can affect you long term, and it's worthwhile understanding them so that you can make proper preparations. Guys, I also wanted to bring an update over a company, silver company, that we have covered before, and some news that they had for those of you that are my stock investors. A lot of you are, so we'd like to include those on the program. We've got a press release here from AbraSilver Resources Corp. We have covered them. They came to the conference and we covered them prior. They've got interesting news about extending mineralization over 600 meters towards northeast behind Oculto Zone. And they also intersected 7.5 meters, grading 8.2 grams per ton gold equivalent. So as you can see, they've got the drill hole results here. They're pleased to report significant drill results received from the latest 4 diamond drill holes of the company's ongoing phase 2 drill program on its wholly owned Diablilos property in Salta Province, Argentina. Now, Salta Province, Argentina is, according to Fraser Institute, one of the best mining areas in all of Latin America. I think it was rated as a #1, according to Fraser Institute, in all of North America. People may not think that in Argentina, but Argentina is very regional. And so it's ranked above most of the mining districts in the US and in Mexico, as a matter of fact. It's very, very good. And so no worries there. And they've got all these drill results. They got, you see here, 108 grams per ton, silver equivalent, 243 grams per ton, 613.6. So really, really good, solid drill results throughout. If you look at the equivalent, if you break down the actual gold and the silver itself, you get 95.7 grams per ton silver, 69, 4.65 grams per ton gold. All throughout here, you see really solid numbers. This is a really good hole. 21-027 had 193.8 grams per ton silver and a quarter gram per ton gold. That's nice. The gold is just a throw in at that point to reduce overall mining costs. So here's where they're drilling. If you look at the map, you can see where they're drilling. Let me blow this up a little bit for you guys. Where they're putting their holes, okay, right here, all across here, and that's where they're finding their silver. So really good. They got 7.5 meters of 4.65 grams per ton gold. 7.5 meters is the width, and that's a really good width to get 4.5 grams per ton gold. And also in that, not only the gold, but the 40.6 grams per ton silver and copper. Now they're polymetallic. They have gold, silver, and copper. 2.1.8% copper is pretty good. The gold, silver, and copper together is really good. They got some other drill results here. You guys can go to their website and take a look at that. AbraSilver Resource Corp at abrasilver.com. We'll put the ticker below if you guys are interested in taking a look at them and their share prices on the markets. That's going to wrap up today's video, guys. I hope you have an absolutely wonderful weekend. We'll get back into our live streams this weekend, this Sunday, and I hope you guys have enjoyed the content after our Money Metal Summit last week was a smashing success. And remember, we're going to get back into more of the basics as you guys asked me to at the conference, more economic talk, more gold and silver talk, and we'll continue to cover that and bring you these videos. I think this video is very important in talking about the difference between what the central bank will tell you and the truth, and how to read the markets and how to do planning and how to understand the data, I think is very important. And we continue to go over this so you don't lose sight of it. If you look at the financial media on an everyday basis, you're never going to get the truth. This video, and we at GoldSilver Pros will tell you the truth, and we'll analyze it and break it all down for you. Thank you guys so much. You have a good weekend, and we will see you on Sunday.